let me ask you this. Do you know how much a $100,000 salary can buy you in 2026? Is it like a shack, or is it a mansion, or is it something in between? Well, it actually depends on what home loan you use and really how aggressive you're willing to get. Now, here's the dilemma. Would you rather play it safe and help yourself in the future, or maximize your purchasing power now, right? There's always a trade. But what I want to do is actually break down what someone making that, magical $100,000 or 6 figures a year can qualify for. And I'm going to be using 4 different methods. I'm going to be starting with the most conservative. It has to do with Dave Ramsey. Okay, then I'm going to go with the 1/3 rule, followed by conventional and the most aggressive loan out there, which is FHA. And then I'm going to throw a little bonus in there with VA loans as well for any active duty service members or veterans. And on top of that, I'm going to be showing you the framework on how to calculate debt to income ratio, or DTI. That is the magic number that lenders care about, right? So even if you're, not making exactly $100,000, maybe you're making $95,000 or $120,000, you can still apply these frameworks. Because remember, education can never be taken away from you. It's something that continues to compound, and you're the asset. Again, this isn't theory. I've learned these frameworks from helping over 500 families get mortgages. And I've also developed the Homeownership Free Trial Guide, which is something that I'm going to talk about later. So let's break down a $100,000 salary to figure out how much home you can afford. Like I said, lenders usually use before tax income, which just means gross income. Okay, so on your pay stub, you're going to see a bigger number and then a little number. It's the bigger number. So for our $100,000 salary, let me grab my phone and let's do the math here. And we want to divide it by 12, right? That's gonna be $8,333, repeating, okay? So that's the amount we're gonna use for this video, just to keep it simple. Now, out of the 5 methods I'm gonna show you today, only one method uses your income after taxes are taken out. So let's lay the foundation and ground rules that will apply for all the other methods. So let's just assume an interest rate of 6%. Let's assume 20% down unless stated otherwise. And then property taxes, we're going to use 1.25% of the home value, and then you divide that by 12, okay? And then homeowners insurance, let's just use $150 a month. And no HOA, just to keep the example simple. So quick disclaimer, I'm sharing frameworks to help you, think about your home budget. And remember, rates change every day, so it could be much lower, fingers crossed, by the time you watch this in the future. So let's jump into it. So method number 1 is the Dave Ramsey method, which is definitely the most conservative method and risk mitigation focused. When people talk about the Dave Ramsey method, they usually mean 2 different rules. Let's start with rule number 1, which is the payment rule. He believes that the total housing payment should be 25% of your take-home pay. So the key word is take home, so that's after tax money. And he wants you to put 20, even 25% down. So for the example, right, we're gonna do a $100,000 salary. Let's figure out income taxes. Let's just assume 20% just for the simple math. So 20% is gonna be taken out for taxes. So then we're left with 80%, okay? So I'm gonna do this on my phone here. So remember, we're gonna do $8,333 a month times 80%, okay? Which equals $6,600 repeating, okay, per month. That's your take-home pay, right? Depends on your tax rate. And then per Dave Ramsey, he doesn't want you to spend more than this number right over here times 25%. So we want to do that times 25%, which is $1,600 repeating per month, okay? And like I mentioned earlier, he wants you to put at least 20 or even 25% down. So rule number 2 is the mortgage term, or in simple words, like how long do you have the mortgage for? And he says the shortest path to wealth is to avoid debt. And the best way to do that is either buy a house with cash or go with a 15-year mortgage, which has the overall lowest total cost, and it keeps the borrower on track to pay off their house fast. So let's hop over to Dave Ramsey's website. I did all the boring work for you. We plugged it in here. So this is the number with the 15-year fixed. It looks to be about a $205,000 home. And again, if you're in California or not the Midwest, I guess, that doesn't get you much. So it might be a little depressing for sure. But I also wanted to show you, well, what if we do kind of like a Dave Ramsey method, but like a Dave Ramsey derivative, the DRD, Dave Ramsey derivative. And we do a 30-year fixed instead, like how much does that affect it? So it goes from, I believe, $200,000 to $260,000 simply by going from a 15 to a 30-year fix, which you may be able to find some houses, in some parts of the country. Overall, the Dave Ramsey idea is excellent in theory, And it is practical for a select few of people in some areas of the country, but I would say it's not practical for the average person. So you have to like balance it with like the mental game too, right? If you just feel like defeated, of like, I can never accomplish this, and you just give up on trying to buy a house, that might not be useful. So that's why there's other methods that we can use. So again, it's kind of like this dichotomy of, do we live super conservative and not spend a single penny, live frugally for the future? Or do we just blow it all on Vegas, right? You probably don't want to be on either end of the spectrum, probably something in the middle, if that makes sense. So let's go over the next method, which is the 1/3 rule. I actually like this the most, especially when I'm talking to clients, they don't know what to afford. I always start here first, and that's part of my homeownership free trial guide, which you can get down below, the link, which uses the 1/3 rule, helps you calculate the payments, all that good stuff. It's called a high yield savings account playbook. So make sure to check out that link below. So the idea here is you're gonna use 1/3 of your income, and that should go towards your housing. Again, around that amount. So the rule is all about giving you breathing room as well, right? So it's not as conservative as the Dave Ramsey method, but you still have a little, it's called buffer for groceries, utilities, gas, savings, travel, all these emergencies, and you just want to enjoy life. So again, it's designed so that way you're not spending all your money on the housing. So with that $100,000 salary, again, before taxes, let's calculate this one together. All right, so we have $8,300 a month, again, repeating, right? Times 33%, so 33% equals $2,749 a month, and that can be your housing expense. So let's see what purchase price someone can afford using the 1/3 rule on a $100,000 salary. Boom, $440,000 with 20% down. Total monthly payment is $2,733. So we're below that amount. So again, it's a lot more than the Dave Ramsey method. Like I said, there's no right or wrong answer. It's just understanding that you're gonna sacrifice a little bit for the future, but also still balancing and not going, house poor. Then method number 3 is gonna be conventional financing. This is like the lender ceiling. So this method allows you to go up to 49.99% of your income. Let's call it 50%, assuming you don't have any other debt, by the way. So again, that's your gross income, assuming you have good credit, strong reserves, all that good stuff. So let's do the calculation. So we got 8,300 repeating times, let's call it 49.99%. You can just do 50%, but we got to be exact here, right? $4,165 a month. Now, I don't usually recommend going to that maximum amount, okay? This is just you could from a lender perspective. Should you? Probably not. Now, the only time that I usually see this, if we're not including other factors, like maybe it's someone who's not married, like a partner, and what they're doing is they're trying to qualify just on themselves and they're not married yet, right? So we're just using one income, but there's 2 incomes total, right? Or, maybe there's like a salary jump that's gonna happen soon, or big inheritance or something like that happening. So again, that's the only time I usually see it or even recommend it. Not saying that you need to max it out. So again, this is assuming no like credit card debt, things of that nature, just to keep things simple. So let's see what purchase price one can afford with conventional financing on a $100,000 salary. Survey says $680,000 with 20% down. That comes out to a payment of $4,139 a month. So in summary, under conventional lending guidelines, a $100,000 income could support a $680,000 home. But again, you're spending nearly half of your income before taxes, and this is based on 20% down with no debts. So do I recommend it? Not necessarily. You have to have other, I would say, reasons for doing it. But remember that spectrum that I mentioned, super conservative, super aggressive. Sometimes it's something in the middle. All right, so this leads me to the most aggressive, which is FHA financing method number 4. So an FHA loan is designed to help not necessarily first-time home buyers, but it's also just other regular buyers as well, put a lower down payment and I would say qualify more easily. So let me break down like why people use FHA. It's usually because you can put a 3.5% down payment and it's more forgiving on credit, right? So let's say you have less than perfect credit or someone has less than perfect credit, it's definitely easier to go through. And you can push the limits on debt to income ratios, which we'll cover later. So lenders actually break down for FHA, this is the interesting one, with a front end limit and a back end debt to income limit, okay? So the front end limit is technically 46.99%, it's called 47. That's just your front number of debt to income. That's just housing only. So just housing only divided by income. Remember, debt to income. So debt divided by income, a little math less than there, right? Then there's the back end ratio, which is 56.99% or 57%. That includes housing plus other debts of like credit cards, installment loans, student loans, and that's based on a monthly perspective, okay? So again, you would want to use your minimum credit card payments for this math. Now, here's the trade-off with FHA is it has upfront mortgage insurance, premiums, things like that. And sometimes you can't caps on the loan amount based on certain counties. So that's something you definitely want to check with your mortgage advisor before you say, yeah, FHA is the best option for me. So definitely double check that. Okay, so let's do the calculation for FHA right over here. So we're gonna do $8,300 a month. And then what we're gonna take that front end number, right? Because it's housing payment only, assuming no debt, right? Times 46.99% equals $3,915. Let's just round it up to 1916. So for this FHA example, so here's some ground rules. Because you can put low down, let's do 3.5% down, the minimum down payment. And then what you actually find out is the interest rate is usually better than conventional. But again, there's like the trade-off of upfront mortgage insurance, premium, all that stuff. So that's typically gonna be 0.5% lower than conventional, just general rule of thumb. So let's call it 5.5%. And then the upfront mortgage insurance premium is 1.75%. And that gets added onto the loan. So you're basically financing that amount over the life of the loan, but then you get a lower rate. So it kind of ends up being balanced out anyways, but tomato, tomato. So remember, you're gonna be coming in with less money down when buying the home. Let's look at FHA and the purchase price based on a $100,000 salary. And survey says, boom, $515,000 with 3.5% down. So total monthly payment is $3,907. Now, obviously, we just calculate some of the numbers here, and it's lower than the conventional option. It's because we're putting $17,000 down, which is less down. And the reason why I call it the most aggressive option, FHA, is because we're like leverage, right? We're putting the least amount down, and then we're maximizing the payment, right? So I would say least aggressive is when the difference is like not as much, right? So again, the trade-off is going to be the payment. Your monthly cost jumps up to $3,900. And that's because FHA allows basically higher debt to income ratios. But you might be wondering, well, what if I did 20% down, like how much I could afford, just to kind of keep it similar to conventional? It's around $620,000. Okay, last but not least is method number 5. That's the bonus one. That's the VA loan. It's definitely the most powerful home buying tool out there. If done right, it's designed for active duty service members, veterans, and sometimes like some surviving spouses. So you're probably why VA loans are super powerful. The big advantage is 0% down, and there's no monthly mortgage insurance, which is huge. And VA has very flexible debt to income ratios. They're more focused on what's called residual income, but that's beyond the scope of this video. Why I like to include VA in the more aggressive category, it's not because it's bad, but because it lets you buy more home with less cash up front. So if you use the definition of aggressive means how little can I put down compared to how much I can buy, like that delta, meaning aggressive, VA would definitely fit that boat. Again, it doesn't have a debt to income limit, but I've seen as high as 65% debt divided by income. I've also seen 70%, but let's just use 65% just for this example. So let's do the math here. So 8,300 repeating times 65%, that gives us $5,416 a month, which obviously is a lot more than all the other options, and it's 0% down. All right, so let's go through some ground rules for VA loans. 0% down, like I mentioned. Interest rates are gonna be very similar to FHA, so about 0.5% lower than conventional, but there's no mortgage insurance, okay? So let's look at what purchase price can we get based on a $100,000 salary using a VA loan. Drum roll, please. Survey says $775,000 with 0% down. Your total payment will be roughly $5,400 per month. So if you see like the scale, I'm gonna put it like right over here on the top. You'll see the most conservative was like all the way from $205,000, and then we could go all the way up to $775,000 for a VA loan. That's why I said in the beginning, is it gonna be a shack or is it gonna be something crazier like a mansion or something in between? So remember, we used the same income across 5 different methods and got wildly different home prices. We started at $200,000, and with VA, that's pretty much like 3.5 times more than the most conservative option, right? So what I'm trying to say is, it's not about what the bank tells you, what you're pre-approved for, or what you could do. What you wanna do is figure out 2 parts of the equation, I should say, right? Remember that spectrum that I mentioned, which is, do you want to be conservative and live frugally now so that way it benefits you in the future? or do you want to sacrifice the future and, let's say, maximize your purchasing power? I guess you would enjoy life right now, but you're not saving for the future as well. Both extremes, probably not where you want to land. Maybe it's something in between. The reason for that, I haven't really heard anyone talk about this, but I like to explain, at least to people that I work with, is there's the qualification and the financial aspect of buying a house, owning a home. And then there's the personal reason that is the life that doesn't live on paper. So it's very hard to quantify, right? If you're one of those people who's like, hey, I don't care about that, and it's just black and white, then I would say you're more on the financial aspect of it. And then that's where you want to land on, I would say, if you want to really live for the future, then you want to be on the more conservative side. But if you're like, hey, I actually, it would be great that I could have the holidays, my kids could enjoy that in the house that I own. Now you're going to be basically starting on the ultra conservative side, and that gravity pull is going to pull it a little towards the center. You might end up ending right around the 33 or the third rule or something in between there as well. So that's how I would digest all this info, because again, it's $100,000 salary, but you got 5 different purchase prices. Okay, so bonus round for those that are the go-getters and want to know about debt to income calculations. So this is the magic number that all lenders care about. And this is actually what I look at first when someone goes through the pre-approval process, right? The reason why this number is super important is because those are boundaries, right? If we go out of that boundary, let's say we're at a 60% debt to income ratio and you're trying to get a conventional loan, you can't do a conventional loan, right? You have to get rid of debt, increase income, etc. So first, let's try to find what box do we land in. Is it the VA box if you're VA, if it's FHA or conventional, etc. So that's why it's super important. So I'm gonna use a pretty simple example, and we're gonna stick with that $100,000 a year. So first thing lenders do is they take that into a monthly payment. So again, that's 100,000 divided by 12. That's the 8,303 repeating number per month that we're talking about. That's your income number. So debt to income. So that's your income, that's your bottom number, right? Now, let's say you have $500 of car payments, $300 of student loans per month. Per month is the key word. And then $200 in credit card minimum payments. That's the key word that lenders use. Minimum payments. Let's add up 500, 300, and 200. That is $1,000 a month. And let's say your housing payment is going to be $2,800 a month. Now what we're going to do is take $2,800 plus the $1,000. Now your total debt is $3,800. So what you're going to basically do is calculate your debt to income. Debt is 38. 2 is translated to divide, right? I know back in the math days, right? Income, $8,300. So if you do the math, it's roughly 46%. So that's how you calculate debt to income. And again, that's almost half your income that's already committed to housing and debt. So hopefully this framework can help you apply it to your income so that way you have a starting point, right? Of where do I land on the comfortability range? And then that's where you want to use that little guide on the spectrum, right? Of hey, I really want to sacrifice now for the future. Pull yourself from the center to the more conservative side. But you're I would like to enjoy my life a little bit more. And I know that there's things in life that does not live on paper that may pull you a little bit this way. So I would use those two kind of as a guide. As always, I try to make the best videos in the mortgage space. So please subscribe, and comment what you want to watch next, or maybe something I missed. And YouTube right over here is recommending this video. So go check it out, and I'll see you there. This is Nathan signing out.